Welcome to the Risk Reversal Podcast. I am Dan Nathan. I'm joined today by my good friend, Peter Boockvar. He is the CIO at OnePoint BFG Wealth Partners. Peter, welcome back to the podcast.
Dan, it's great to be back. Appreciate always being on.
All right, we're just calling this is kind of the book report. We're doing this early in the week. We're kind of looking ahead at some of the stuff that's on your radar. You guys know where to find Peter. You can find him on Twitter, but also at the book report. That's BOOCK report. That is a daily newsletter. It's one of my first reads every day, but he updates it all day long. So go check that out. All right, Peter, it is Tuesday afternoon. We are basically, 2:30 or so. The stock market is raging. The S&P 500 is up 1%. The NASDAQ is up about 1.25%. The NASDAQ on the year is almost up 13%. And the S&P is up nearly 10%. We had the CPI reading for July this morning. There was a lot of trepidation about this print. Let's break it down a little bit, and then we'll broaden out to what we're seeing in the stock market, because it really does feel like at new all-time highs. There's a little bit of, I'd say, excitement. Maybe it's euphoria, but we'll talk about that in a second. What did you see out of that CPI, and what is the thing that is causing investors to go batshit crazy for stocks today?
Well, I think going into the number, people were a bit concerned that the tariffs would lead to an upside surprise. And that's not what we got. We got a number that was pretty much spot on, in line with expectations. But the tariffed part of the internals numbers, particularly the imports of certain goods, continued to show a pretty robust 2-month price gain for anything related to the home, toys, audio equipment and products there, photographic equipment, sporting goods, all seeing full year gains all within 1 or 2 months. On the services side, still remaining pretty persistent. And just to quantify the goods side, the year-over-year core goods increase of 1.2%, while it doesn't sound like a lot, it's actually at a 2-year high. So we are seeing a bottoming in goods and sort of a flatlining in services. But I think the market response, and you can look at treasuries, is that sort of the first measure of how the market believes that will influence the Fed. The 2-year yield has fallen about 3 basis points, while the 10-year yield is actually slightly above where it was at, call it 8.29. So I think the market's assuming that it was not a good number, in the sense that we still have 3.1% core inflation, but it wasn't worse than expected that would prevent the Fed from cutting interest rates in September. So I think between this and the weak payroll number of a few weeks ago, the Fed is sort of locked in to cutting interest rates. Now, what they do past that, obviously we don't know, but at least for September, I think that's what the market is sort of celebrating. But again, it's how many times are we going to celebrate the prospects of Fed rate cuts? I think people have been so trained to just buy stocks agnostic to valuation when the Fed is cutting interest rates. And I think that payroll number, we had that one day, obviously hissy fit on the downside, but people then on Monday said, well, Fed's going to cut interest rates. Let's buy stocks. But even with the CPI number, again, 3.1% year-over-year core, up 0.3 month over month. Okay, maybe we'll get a cut. Maybe we'll get a second one by end of the year. But with 3% pretty persistent inflation, there's not going to be that much more after that. And if the U.S. economy continues to soften, which I expect it to in the back half of the year, as tariffs further work their way through, basically neutering and the tax benefits from the tax bill on the CapEx side. I mean, we're starting the second half with 1% growth as sort of a backdrop. So by when the Fed cuts is the mentality. We'll see how long that lasts, but 3% inflation persistently is not going to lead to too many more cuts.
Right. But with the stock market at all-time highs, trading at about 22.5 times forward, and if you're saying that
forward 12 months, but trading at actually 24 now, full 2025. I think Jay Powell is going to be pretty steadfast in not letting this inflation genie get out of any bottle. At the same time, he'll acknowledge the softening of the labor market. But I think when you combine the two, he's going to be rather circumspect. I think he's going to give the market, okay, yeah, I'll cut in September, but what I'll do after that, I don't know yet. As opposed to Michelle Bowman, another Fed governor who's seemingly jockeying for his job, says, yeah, let's cut 3 more times by the end of the year. I mean, my crystal ball is not that good to sort of game out what's going to happen over the next 4 months, particularly with the influence of tariffs still flowing through these inflation numbers. So I don't think Jay Powell is just going to roll over for Trump. I don't think he's just going to say, okay, yeah, we're going to cut, employment's rolling over. I don't care about 3% inflation. I think he's really going to just give us guidance on what they'll do in mid-September and nothing past that, because he's got a very limited time, as we know. And I think he is solely focused on his legacy, solely focused on what his backbone is relative to all the bullying, not just the bullying in the administration, but also sort of the bullying within the committee, in the sense that we've already gotten a couple of dissents. And now you have one saying, instead of 2, let's cut 3. So I don't think he wants to go out into retirement with being too easy and inflation rising again as he exits stage left. I would tend to think that a hawkish cut is what he's sort of going to imply.
Well, let's talk about some of the price action in the stock market today, because you just mentioned, housing prices. Look at home builders. I mean, they're kind of raging today, right? And so we have a 4.3% 10-year. We have a 30-year fix that I think is still about 6.8%, right? It's kind of been stuck up in that level. That's where it was about a year ago before the Fed started cutting the Fed funds rate. Why are home builders, why are banks? I'm looking at the money center banks. Citigroup is up 3%, Bank of America, Wells Fargo, JP all up more than 2%, Goldman, Morgan Stanley up nearly 3%. Why are the banks acting this way, and why are home builders raging?
Well, as you said, the 10-year yield being flat, no reason for the home builders to rally. But I do think that this is your classic Fed's going to cut by everything interest rate sensitive, not just continue to buy those momentum stocks, but buy the groups that you mentioned. And also let's buy small caps and mid caps, and everything is going to benefit from Fed rate cuts. So to me, when you get that sort of response in the banks and the home builder, that explains this rally. Again, even though CPI was in line, we're now pricing in almost 100% chance of a September cut, and it's close your eyes, buy stocks. But I think people are forgetting that most of the time that has worked in the past. But the Fed was cutting actually July 2007 and then October 2007. The market went to an all-time record high because people thought, okay, Fed's cutting interest rates, you have to buy stocks. And we know what happened after that. And it's this blind faith in Fed cuts solving all of our problems. And that's what's going on here.
We have 3% inflation and we have 1% growth. Okay, so that's stagflation. Our friend Doug Cass calls it slugflation, whatever you want to do. I mean, isn't that where we're likely to end up? Because if we don't see, I just don't understand what the circumstance would be to reaccelerate economic growth here, above 2%, 2.5% or something like that. And so help me understand that. I mean, I just laid out a scenario where the stock market, at least investors, could start to perceive what comes next out of this generative AI trade. And, you just mentioned the mega caps, you have 2 to 3% earnings growth for a lot of other sectors. What is the sort of thing, in your opinion, that could re-accelerate economic growth? Is it that, the trade war, we find ourselves at tariff rates that are below 10% across the board, like we continue to ratchet it down because they come to their senses in the White House or whoever's advising them that this is going to be the sort of thing that weighs on growth. And if you want to kind of take your foot off the neck of this economy, you got to scale back tariffs.
All right. So scaling back tariffs would help. But let's go through some of the areas of weakness in the economy currently that we would need to see flip to the positive side in order to get faster growth. Let's take the sector that's most impacted by tariffs, manufacturing. Manufacturing in the US and globally, for that matter, has essentially been in a recession for more than 2 years now. So if you dramatically ratcheted back the tariffs, well, maybe you can get a lift to manufacturing. We get a lift in inventory build and so on. But there's no signs that we're going to get a rationing back of tariffs, so manufacturing is still going to be challenged. I recommend people to look at the stock Celanese, CE is the stock symbol, and read through their press release and earnings call because they are right in the storm of this manufacturing downturn. Lower to middle income consumers have been in their own recession. What can we do to lift them out of this? Well, you have to slow the pace of this rise in the cost of living. Tariffs are certainly not helping there. One thing that could help the economy is on the non-AI CapEx side, which has been rather lackluster, and the recently enacted tax bill and all the tax incentives that have been announced in terms of accelerated expensing. Can that lift capital spending? to a point where that would offset the tariffs. Maybe we'll have to see, and that's a key thing to watch. Global trade, I don't think we're going to get much help with global trade as long as tariffs are in the place that they're at. So there aren't many places to get that reacceleration if tariffs don't decline in terms of their rates, because it's very punitive, the level that we've seen. And I do think that's going to, like, somebody sent me something today from an economist that said the tax changes in the big beautiful bill is essentially going to be cutting in half the corporate tax rate. And my response was, well, we're basically doubling the corporate tax rate with the tariffs, so maybe we're no better off either way. So I think that's a long-winded answer to try to figure out where we would get reacceleration. But on the other side, we also need certain things to continue on. This AI tech trade, this AI capital spending binge is not a forever thing. You can't forever spend 35% of revenue on CapEx. At some point, you're saying to yourself, okay, I built out what I wanted to build out. Now I hopefully can reap the benefits, but I'm going to ratchet back my spend. Well, that's going to have major economic implications if this AI spend is ratcheted back or at least paused. Government spending has been a major lift to the economy, while the pace of increases is potentially going to be slowing. And the stock market is tied into the economy. If for whatever reason we got a notable pullback in the stock market, that in itself can have its own impact on economic activity. And on the flip side, the stock market keeps on going, well, upper income spending will continue as is.
All right, last question. I know we got to get out of here. There was this notion after the S&P rallied, let's call it 30% off of those April lows, that the administration had some room to play with, right? Like when they came out in late March, early April, they told you what they were going to do. They were going to reorient global trade, and they were going to do it with a big stick. And, they came out, and I think a lot of people were just, didn't know what to make of that April 2nd rollout. And I think that obviously almost every major risk market went batshit crazy. And here we are now. A lot of folks, I think we're, kind of came to this mindset, well, maybe they have a little room to play with. Maybe they actually don't have to push some of these deals out. Maybe they can put the reciprocal tariffs back on, and they already know how the market's going to react. We've seen the treasury market really calm down. We've seen credit spreads, corporate credit spreads really calm down, right? We've seen the US dollar, while it hasn't rallied much, but it's not as volatile as it was, a few months ago. The stock market, it seems there's an insatiable appetite for risk. So maybe they try to do the hard things that they set out to do, right? Well, now it actually, I think a switch has flipped here a little bit. It almost feels like they might do everything they can to juice the markets, and thinking that they're also juicing the economy. Is that something you're starting to think about a little bit?
Well, I think they're trying to do that through pressuring Jay Powell and getting their people onto the Fed to cut interest rates. That's the way at this point they plan on trying to juice the economy to offset the negative impacts of tariffs, somewhat mitigated by the tax bill. To me, that's their belief. But they feel emboldened by what they've done on the trade side, because they're saying, well, market's at all-time highs. No one's giving us a thumbs down. The economy is not in a recession yet, even though, again, it's not really growing much. But that they feel emboldened by this. And as long as they do, that means the tariff pressures will continue. Now, at some point when the economy further rolls over, which I expect it to, maybe there'll be a different thought. But their juicing is all central bank related at this point, because I think that's sort of the lever they feel like they can pull by putting in their people into these particular spots, like the Kugler governorship and whoever will replace Jay Powell.
All right, Peter Boockvar, I really appreciate you being here. You are the CIO of OnePoint Wealth. Appreciate you being here. We'll see you next week, Peter. Thanks so much.
Thanks, Stan. Appreciate it.